If you happen to be born before the year 1961, then on the exact day you reached your 65th birthday, you became legally exempt from a surprising stack of bills and taxes that you are almost certainly still paying to this day. And let me be very honest with you. No one whose job it is to collect that money is ever going to pick up the phone, send you a letter, or knock on your door to tell you to stop. I want to make sure you fully understand what I just said, because this is quite simply the single most expensive misunderstanding I come across year after year. Turning 65 did not just grant you access to Medicare. Quietly, almost invisibly, it moved you into an entirely new category of people that the federal government, your state government, your county, and a handful of other agencies are legally required to treat differently than younger individuals. There are bills that younger people have no choice but to pay that you no longer have to pay. There are taxes that get smaller or freeze in place or vanish completely the very moment you cross that age threshold. But here is the catch, and it is a catch that ends up costing people thousands upon thousands of dollars every single year. Being legally exempt from something and actually stopping your payments are two completely different things. The law does not automatically send you a refund. No one at the county treasurer's office mails you a check just because you had a birthday. The agency that has been happily collecting that money from you for 40 years does not send a cheerful note on your birthday saying, "Congratulations, you can stop now." You have to know that the exemption exists in the first place, and you have to physically file the correct form. That single gap, the space between qualifying and actually claiming, is the reason most people who are fully entitled to these benefits never see a single dollar of them. And before you decide that this video is not for you, let me clear up the biggest myth of all right now. Because this myth is exactly how people talk themselves out of money that is sitting right there with their name on it. Some people assume a list like this is only for low-income retirees who are genuinely struggling to get by. So if you own a comfortable, paid-off home, you tune out and assume none of it applies to your situation. Then other people assume the exact opposite. They think this list is only for the wealthy, the folks with large estates and fancy accountants who know every trick in the book. So if they live mostly on a Social Security check, they tune out as well. Both of those people are wrong, and both of them are leaving money on the table. Some of the things on this list help the lower-income retiree the most. Other items on this list are worth the most to the person sitting on a house that has doubled in value over the last few years. On every single exemption, deduction, and program I am about to share, I am going to tell you exactly who it helps the most. That way, no one watching can honestly say, "Well, that part is not for me." And if you are renting right now, do not click away either, because one of the things on this list quietly controls how fast your rent is allowed to climb each year. So let me briefly tell you who I am and why I am the person delivering this information to you. My name is Dr. Mandell. I am a state bar licensed estate attorney, and for more than 15 years, I have sat across the table from county assessors, probate clerks, and government agencies on behalf of ordinary families. And I will tell you the most painful pattern I have witnessed in all those years. It is not the people who try to cheat or game the system. Those individuals are very rare. The truly painful case is the honest person in their 60s, 70s, or 80s who has done everything right their entire life and is still paying bills they were legally exempt from years ago, simply because not one single person ever sat them down and told them which form to file. That is the most expensive kind of mistake there is, because it is completely invisible. There is no late notice. There is no penalty. There is no alarm that goes off. There is just money, your money, quietly leaving your account every month, every year, that never had to leave at all. So let us fix that problem right now. Today, I am going to walk you through 5 of these exemptions and programs one at a time, in plain English, with the exact thing you need to ask for on each one. Then I am going to give you a few bonus moves at the end for the homeowner who has some real assets, because those last ones can be worth a small fortune and almost no one talks about them. And I want you to stay with me all the way to the end because the fifth item on this list is the highest in value of them all, and it also happens to be one of the very easiest to claim. If you only act on one thing from this entire video, it is probably going to be that one. Let us start with the newest program first, because it is so new that almost nobody has caught up to it yet, and that is exactly why it is being missed on such a large scale. Starting with the 2025 tax year, every single American who is 65 years or older qualifies for a brand new bonus deduction of $6,000. And I want to be very precise here because people get this wrong all the time. This is not instead of your standard deduction, it is on top of it. This is an extra $6,000 knocked off your taxable income just for being 65 years old. And if you are married and both you and your spouse are 65 or older, that is $6,000 each, $12,000 as a couple, stacked right on top of everything else you already get. This deduction is brand new. It runs through the 2028 tax year, and here is the part that surprises most people. You get it whether you take the standard deduction or you itemize your deductions. It does not matter which way you file your taxes. Now, it does begin to phase out at higher income levels. As a single filer, it starts shrinking once your income climbs past $75,000, and for a married couple, it starts shrinking past $150,000. At the very top, above the higher cutoffs, it disappears entirely. But think about who that leaves: the vast middle, the retiree living on a normal, modest income. For that person, this is real money taken straight off the amount the government is allowed to tax. Here is what genuinely bothers me about this one. On top of that deduction, a number of states no longer count your assets at all when determining eligibility for certain programs. That means things like savings accounts, a paid-off car, or even modest retirement funds may not disqualify you the way people automatically assume they will. So you could look fine on paper and still qualify for help that pays that Medicare Part B premium for you every single month. And this is where Dr. Mandell always emphasizes something very important to the people he works with. This is not a benefit you guess your way into. It is a benefit you confirm. Each of those programs, QMB, SLMB, and QI, has its own income threshold, and they change slightly depending on the state you live in. But the application itself is not complicated. In most places, it is a short form submitted through your state Medicaid office or your local social services department. If you are already receiving Social Security, you are often halfway identified in the system already. But the key issue is the same one we keep seeing again and again throughout this list. Nothing is automatic. Even when you clearly qualify, the system will not enroll you unless you, or someone acting on your behalf, actually files the paperwork. And here is the part that surprises most people. Even if you do not qualify for the full premium coverage under QMB, you may still qualify under SLMB or QI, which only cover the monthly Part B premium, but still save you thousands of dollars per year. A lot of retirees fall into that middle zone and never realize it, simply because they assume it is all or nothing. So the practical step here is straightforward. If your income is modest, or even moderately comfortable but not high, it is worth checking the threshold in your state, and if you are close, you still apply. Many approvals happen in that close enough range that people mistakenly self-exclude themselves from. And that brings us to number 4. The first bonus move is a property tax deferral. In a number of states, once you reach a certain age, you can choose to stop paying the property tax bill entirely, and the state simply settles up later when the home is eventually sold or passed on to your heirs. Now, this is not forgiveness. The bill does not disappear. It is essentially paused and moved into a deferred balance that sits against the property. For some homeowners, especially those on fixed incomes or living primarily on Social Security, this can be a way to stay in their home without the constant pressure of rising annual tax bills. But there is an important detail most people miss. Not every state offers this program, and in the states that do, there are usually conditions attached. Some require that you have a certain level of equity in the home. Others place limits based on income or require that the property remains your primary residence. And in some cases, interest continues to build on the deferred amount over time, which is eventually paid when the home changes ownership. So this is not a casual decision. It is a tool, and like any tool, it only makes sense in the right situation. For someone with limited cash flow but a strong attachment to their home, it can provide real breathing room. For others, especially those planning to pass the home to heirs debt-free, it may not be the best fit. Dr. Mandell often puts it very simply when explaining this to families. You are not escaping the bill, you are choosing when it gets paid. And that framing is important because it shifts the decision from fear to planning. The second bonus move is something called a capital gains exclusion on the sale of a primary residence. Most homeowners already qualify for this, but very few understand just how powerful it truly is. If you sell your primary home, you may be able to exclude up to $250,000 of profit from taxation if you are single, or $500,000 if you are married filing jointly, provided you meet the ownership and residency rules. For people who bought homes decades ago and saw values rise significantly, this can translate into tens or even hundreds of thousands of dollars in tax savings. The key detail here is timing and documentation. You generally need to have lived in the home for at least 2 of the last 5 years before the sale, and the IRS looks closely at whether the property truly qualifies as a primary residence. Mistakes here can lead to unexpected tax bills that people never planned for. The third bonus move is often overlooked entirely, and it involves required minimum distributions, or RMDs, from retirement accounts. Once you reach a certain age, you are required to begin withdrawing funds from traditional retirement accounts, such as IRAs and 401ks. What many people do not realize is that poor planning around RMDs can push you into higher tax brackets, increase your Medicare premiums, and reduce your eligibility for certain income-based programs we have already discussed. On the other hand, careful planning, sometimes involving Roth conversions or strategic withdrawal timing, can significantly reduce your lifetime tax burden. This is one of those areas where professional guidance really matters because the rules are strict and the penalties for mistakes are very real. And this is where Dr. Mandell always brings the message back to a simple point. None of these programs are hidden in the sense of being secret, but they are hidden in practice because no single agency is responsible for telling you how they all connect. That is why so many people only discover them after years of overpaying. The final takeaway is straightforward. These benefits are not about loopholes or tricks. They are structured parts of the system that only work if you actively claim them. You keep your cash flow. Now, the second is the surviving spouse carryover. When one spouse passes away, the senior exemptions and the assessment freeze do not automatically transfer in many places, and families lose them by accident. But if you file the right paperwork, the surviving spouse can often keep that deceased spouse's exemption alive instead of watching the tax bill jump in the worst possible year. And the third is one people laugh at until they actually add it up. In a number of states, once you hit a certain age, your vehicle registration or your annual excise fees get reduced or waived entirely. It is a small amount every year, but it is your money and it is sitting right there waiting for you. So let me bring all of this back to where we started, with a real person. I once worked with a woman I will call Margaret. She was 72 years old, living up near Toledo, a widow in a paid-off home that had quietly doubled in value over the years. She was getting by mostly on her Social Security and a small pension. And when we sat down and looked at her situation, here is what we found. She was paying the full Medicare Part B premium every single month. She was paying the full unfrozen property tax bill on a home that had appreciated for years. And she was paying more in federal tax than she actually owed because her preparer had never applied her senior deductions or adjusted her withholding. All three of those things at the same time, and every single one of them was something she had the legal right to stop. So we filed three forms: a Medicare Savings Program application, the senior exemption and freeze with her county, and a corrected tax return. Nothing about Margaret's life changed. She did not move. She did not sell anything. The only thing that changed was how much of her own money stayed in her bank account at the end of every month. And here is the part I want you to really hear. She was not gaming the system. She was not getting away with anything. She was simply finally claiming what she had already earned over a lifetime of doing everything right. That is the entire point of what I am telling you today. Being legally exempt and actually keeping the money are two different things, and the only bridge between them is the form. The agencies are not going to build that bridge for you. So here is exactly what I want you to do this week, and none of it costs you a single dollar. First, call your county assessor's office and ask them by name whether the homestead exemption, the senior exemption, and the assessment freeze are on file for your property. If any of them are not, ask which form adds them and what the deadline is. Next, call your local SHIP office, that is the State Health Insurance Assistance Program, and ask them to screen you for a Medicare Savings Program. And finally, the next time your tax return is prepared, confirm that your senior deductions were applied and ask whether your withholding should be adjusted, and if the cost of paying someone is part of why you have been putting all of this off. Listen closely, because you do not have to pay anyone. There are two free programs staffed by trained IRS certified volunteers. One is called Tax Aid for the Elderly, and the other is AARP Tax Aid. They will sit down with you and file your return for free, and they know exactly which senior deductions to look for. So for most of you, the cost of finally catching every one of these exemptions and programs is nothing at all. That is it. A few phone calls and a couple of forms standing between you and money that has been yours all along. If this information caught you off guard, there is another video right here on the channel where I walk through those property tax forms in much more detail, state by state. It is the same kind of money hiding in the same kind of silence, and the card for it is on your screen right now. One last quick thing, and it matters. This is general education, not personal legal or tax advice. These rules really do vary by state and by income. So always confirm your own situation with your county, your state SHIP office, or a qualified professional before you take action. And if anything in here helped you, do one thing for me in return. Send this to one person you know who is over 65. It will not cost you a thing, and it just might put a few $100s back in their pocket every single month. I will see you in the next one.